You went to bed in a world where the price of silver was a number you could argue about. And you woke up in a world where that number is starting to look like a confession. Not a confession from you, but a confession from the people who were supposed to keep the machine running smoothly. Because when the screen turns red at the exact moment the supply line tightens, that isn't the market talking. That's the mask slipping. And you can feel it, even if you can't yet explain it. I want you to notice what your body did when you saw that vertical drop. Your chest tightened, your brain started bargaining, and a little voice whispered, "Maybe it's over." Why do you think the system trains you to react like that? Why do you think the most violent moves always happen when you're least prepared, when the liquidity is thin, when people are half asleep, when it's a weekend, when you can't call anyone who matters? Because panic is not a side effect. Panic is the product. They will call it a pullback. They will call it a healthy correction. They will call it profit taking. But you and I have lived long enough to know that sometimes the chart is not a mirror of reality. Sometimes the chart is a weapon pointed at your nervous system. And if you can learn to spot the difference, you stop being the easiest victim in the room. This is not about one red candle. This is about what that candle is trying to hide. It's about a world splitting into two realities that no longer agree on the same story. The paper world is still pretending it can set the price of a physical necessity with a keyboard. The physical world is quietly refusing to cooperate. And you're watching the bridge between them crack plank by plank in real time. We told you this wouldn't end quietly. We warned you that the end of an era doesn't only arrive with fireworks and a press release. It arrives with glitches, with temporary rules, with spreads that shouldn't exist, with inventories that vanish without headlines. It arrives with the strange sensation that the number on the screen is saying one thing, while the real world is doing the exact opposite. And that feeling you can't shake tonight is your instincts catching up to the truth. Let's slow down and name the first mechanism, because if you can name it, you can stop worshiping it. In the old days on the floor, they called it painting the tape. In the digital age, the modern cousin is spoofing, layering, flooding the book, pushing the price into a pocket where stops live like sheep behind a thin fence. What happens when a market is deep, healthy, and honest? Big sellers sell like professionals over time, trying not to hurt themselves. What happens when you see a dump that looks like someone trying to get the worst possible price on purpose? You have to ask the question nobody wants to ask out loud. Who benefits from a worse price? In a normal market, the seller wants the best average. In a stressed market, the seller might accept a discount, but still not a self-inflicted cliff. The cliff is different. The cliff is someone throwing weight onto the price to trigger your automatic reactions. The cliff is someone trying to force the market to print a story, because the story is what moves the herd. And the herd, when it moves, becomes inventory for the people who engineered the stampede. This is how a bear trap works when the product being traded is your attention. They hit the tape hard enough to make you believe the move is real, and then your stop loss does what it was designed to do. It sells you out at the worst moment. Your broker calls it risk management, the system calls it liquidity, and the predator calls it a meal. And the cruel part is that you feel responsible for your own loss, even though the timing was engineered to make you flinch. Now, I'm not here to tell you that every sharp move is manipulation, or to give you a bedtime story where the bad guys control everything. That's not how reality works. Reality is messier, and the system doesn't need to control everything to hurt you. It only needs to control the moments that matter, the moments where leverage breaks, where margin calls hit, where forced selling becomes a chain reaction. What happens when a leveraged crowd piles into the same trade and the exit door is narrower than the room? You get a stampede, and then you get the narrative that blames the stampede on sentiment, not on structure. And structure is what matters here. Silver is one of those markets where the structure has been stretched for so long that people forgot it could snap. Paper claims can multiply because the system is built on rollover, netting, and faith. Contracts can be created, traded, and extinguished without a bar moving an inch. And as long as most people treat exposure as ownership, the illusion holds. But what happens when more people start asking for the real thing, or when the real thing becomes strategically important in a way it wasn't allowed to be for decades? And you can feel the answer. The illusion gets loud. The illusion becomes theatrical. The illusion starts begging you to look away. They want you staring at the price, not at the plumbing. They want you arguing about candles, not about vaults. They want you distracted by the screen while the physical world gets reorganized underneath you. So let's talk about the second mechanism, the one that actually matters more than the candle. The supply line, the choke point, the policy lever that doesn't need to announce itself with sirens to change the entire game. Because while you were watching charts, a clock hit midnight on Thursday, January 1st, 2026. And when that clock hit midnight, the rules around strategic materials didn't get looser. They got tighter. You've heard the phrase export ban thrown around like a grenade. But even if you soften the word, even if you replace it with export licensing and restricted channels, the meaning is the same where it counts. The era of frictionless flow is ending. The era of just call a refinery and the metal shows up like magic is ending. And the reason that matters is because modern industry isn't built for friction. It's built for speed, precision, and predictability. When you add bureaucracy to a supply chain, you add time. When you add time, you add panic. And when you add panic, you create buyers who stop caring about spot price and start caring about survival. Ask yourself a simple question that cuts through all propaganda. If a major supplier tightens control over outbound flow, is that bullish or bearish for availability outside that supplier's borders? You already know the answer. So why does the price action try to tell you the opposite? Why does the screen try to whisper, nothing to see here? At the exact moment the real world is building fences around the metal, this is where the East versus West motif stops being a slogan and becomes a map. The West built a financial empire on paper claims, futures, ETFs, unallocated accounts, pooled exposure, layers of promises on top of promises. The East built an industrial empire on physical inputs, refineries, warehouses, factories, ports, energy infrastructure. The West got rich slicing and selling abstractions. The East got powerful locking up the things abstractions are supposed to represent. And now those two empires are colliding, not with tanks, but with export permits, shipping lanes, and inventory. When people say the price is the price, what they're really saying is the paper market is still in charge. But what happens when the paper market is pricing something that has become a strategic bottleneck? What happens when a metal isn't just jewelry and coins, but a nervous system for electronics, a conductor and energy transition hardware, a critical input for high-tech manufacturing, defense systems, and the infrastructure you pretend you can't live without? Suddenly, the people who can control the flow don't care about your paper narrative. They care about their own resilience. They care about their own leverage. They care about keeping the real asset inside their own borders. And if you think that sounds dramatic, let me remind you how the world has behaved every time a resource becomes strategic. They don't announce it as a moral crusade. They announce it as national security, supply chain resilience, proper licensing, or compliance. They wrap the weapon in paperwork so polite people can pretend it isn't a weapon. But the effect is the same. The free trade era ends quietly, and then you wake up one day and realize the old assumptions are dead. We told you it wouldn't end quietly. This is exactly how it ends. Not with a single explosion, but with a tightening. Not with one headline, but with a series of temporary rules that never get reversed. And if you want the right mental image, don't picture a bomb. Picture an anaconda. The anaconda doesn't kill its prey with one bite. It wraps around the chest and waits. Every time the prey exhales, the snake tightens just a fraction. The prey panics because it still has some air at first. It thinks it can fight. It thinks it can sprint. It doesn't realize the real enemy is time, because the next breath is the one that won't come. And that right there is your silver market under a tightening export regime. You still have some air in the lungs. There is inventory sitting in warehouses. There are shipments that left before the rules changed. There are pipelines that were filled in December and will arrive in January. The factories are still running, and that gives the paper market a window to lie with confidence. They can point to the fact that nothing is seized up yet and say, see, it's fine. But fine is not a condition. Fine is a delay. What happens when the delay runs out? What happens when the last shipments that were already in motion get consumed? What happens when procurement officers stop asking, what's the price? And start asking, do you have it? That's the moment the paper price becomes almost irrelevant, because the buyer who needs the metal doesn't care about the screen. They care about the loading dock. And you can already see hints of that divergence if you stop letting the screen hypnotize you. You hear it in delivery times. You see it in premiums. You feel it in the way physical buyers behave when the price drops. In a normal market, a big drop scares buyers away. In a stressed market, a big drop invites buyers in because they don't believe the signal. They see it as a discount on oxygen. This is where people who think only in charts get blindsided. They assume price causes demand. Sometimes it does. But when demand is inelastic, price doesn't cause demand. Necessity causes demand, and necessity doesn't negotiate. Silver is not an abstract token in the industrial world. It is used, it is consumed, it is embedded into hardware and disappears from the tradable pool. Once it's in a solar panel, it's not coming back quickly. Once it's in electronics, it's dispersed. Once it's in specialized pastes and components, it becomes part of a machine that can't stop without consequences. So ask yourself, what kind of buyer is more dangerous to a paper system? The retail speculator chasing momentum, or the industrial buyer who will pay whatever it takes because shutting down costs more than any price? Now we reach the third mechanism, the geopolitical one that people love to wave around without understanding. The petrodollar story, the de-dollarization story. The idea that if energy trade stops demanding dollars, then dollars come home and inflation rises and metals get repriced. There is truth in the broad arc, but I want you to be careful about the temptation to turn it into a fairy tale. The world doesn't flip a switch and abandon the dollar overnight. It reroutes flows quietly, it experiments, it uses workarounds, it builds alternatives while pretending nothing is happening. Why does it do it that way? Because the old system still has teeth. The old system still has sanctions, enforcement, banking choke points, and legal reach. So the transition happens. Like water finding cracks. Sometimes it's local currencies, sometimes it's barter, sometimes it's intermediaries, sometimes it's prepayment, sometimes it's new payment rails that bypass traditional ones. The details shift, but the direction matters. And here is the key. When countries that sit on real resources start thinking in terms of strategic leverage, they behave like strategic actors, not like price takers. The West spent decades assuming it could set the price of everything because it controlled the financial architecture. But what happens when resource producers decide the financial architecture is part of the problem? What happens when they decide to build trade that is insulated from Western interference? What happens when they choose resilience over integration? You're watching that question unfold across commodities: oil, gas, critical minerals, industrial metals. And silver sits at a strange intersection because it is both a monetary metal in human psychology and a critical industrial metal in modern infrastructure. That dual identity is exactly why the old system wants it mocked and minimized. The old system prefers assets that can be inflated away, diluted, printed, or recreated digitally. Silver is stubborn. Silver is physics. Silver doesn't care what talking heads say at a studio desk. So when someone tells you Venezuela and China are building a bridge that bypasses the dollar, don't get trapped in the literal. The deeper point is that the world is experimenting with ways to trade necessity outside the old rails. And every successful experiment, even if small, teaches the system that alternatives are possible. Once that psychological barrier breaks, the dollar, ES privilege, stops being a law of nature and starts being a policy choice that can be challenged. Now combine that with the supply chain tightening we just walked through. If you are a producer bloc, if you are an industrial bloc, if you are building factories and infrastructure, do you want low commodity prices forever? Or do you want the West to finally pay true prices for the resources it consumes? You already know the answer. Low prices were a subsidy to the consumer. High prices are leverage for the producer, and leverage is what geopolitical actors crave when the old order starts wobbling. That's why 73 on your screen can be a trap. Not because 73 is a magical number, but because the visible price can be pushed down even as the invisible scarcity rises. It's just an act. It's like watching the thermostat say the house is cool while you smell smoke in the walls. Which signal do you trust? The one printed by the system, or the one felt by reality? We told you the market would eventually be forced to choose between paper credibility and physical delivery. You can fake a quote, you can spoof a book, you can push a candle, but you cannot spoof a bar you don't have when someone demands delivery. At that moment, the system does what it always does. It changes the rules, it finds a cash settlement, it rewrites the contract, it invents a clause, it begs for time, and every time it does that, it teaches more people that the paper world is not ownership, it's permission, and permission can be revoked. That's why the banks, the large intermediaries, the custodians, the institutions that live on leverage have one core instinct: discourage you from demanding reality. They want you trading exposure, not accumulating the thing. They want you clicking buy and sell on a promise, not taking metal off the shelf. They want the crowd in the casino, not outside the vault. So when they slam the paper price, ask yourself what they might be buying. Are they selling real silver, or are they selling a story? And if they're selling a story, what story is it? The story is that the rally is over. The story is that you were wrong. The story is that you should go back to chasing whatever the mainstream has anointed as safe and modern this week. The story is that you should stop asking uncomfortable questions. But the uncomfortable questions are the whole point. Why do premiums stay high when spot falls? Why do delivery times stretch when charts say glut? Why do inventories vanish quietly while headlines talk about weak demand? Why does the market need sudden vertical smashes during thin hours to discover the price? If the supply is abundant and the market is free, shouldn't the truth be stable enough to stand on its own without theatrics? You can already hear the excuses forming. They'll tell you it's just speculators. They'll tell you it's just a macro trade. They'll tell you it's just a stronger dollar. They'll tell you it's just rates. And yes, all of those forces exist. But again, the question is structure. The question is whether the visible price is being used to manage perception, while the invisible world is being managed for control. Now talk about the people who will never appear in your comment section, but who will decide how this ends. The industrial buyers, the procurement officers, the executives who don't care about your chart patterns because they have factories that must run. These people don't buy because they're bullish. They buy because they're cornered. For decades, the global supply chain was built on just in time. It was elegant, efficient, and fragile. You order on Monday, it arrives on Tuesday, you assemble on Wednesday, you ship on Thursday. No inventory costs, no warehouse risk. That system only works when trade is smooth, Politics is quiet, and nothing critical gets weaponized. How is that working out now? We are living through the era where just in time is being buried and just in case is taking its place. And just in case is not a small change. Just in case means hoarding. Just in case means buying months of supply. Just in case means over-ordering, stacking inventory, building buffers, paying premiums, locking contracts. Just in case is a silent tsunami that doesn't show up on a daily chart until it's too late, because it doesn't announce itself as speculation. It announces itself as risk management. This is how a real shortage forms. Not as one dramatic moment, but as 1,000 quiet decisions in boardrooms. A factory manager hears about export licensing, and he tells procurement to secure more. Procurement calls suppliers, and suppliers raise terms. Another manager hears the same rumor, and he orders too. Soon, everyone is ordering a little extra, and a little extra becomes a vacuum. Then the pipeline drains, and the vacuum becomes a crisis. And here's the paradox that the paper market can't fix with a keyboard. If the paper price goes down, the industrial buyers feel relief, not fear, because their cost basis improves while their necessity remains. The lower it goes, the more they can lock in, the more they can secure, the more they can stockpile. So the very act of smashing the paper price can accelerate physical drawdown. That is not a stable equilibrium. That is a feedback loop. This is why I keep telling you to stop thinking in terms of bullish and bearish, like a day trader. Start thinking in terms of regime change. Start thinking in terms of what happens when a monetary asset becomes a strategic input. Start thinking in terms of what happens when the world fractures into blocks with different incentives. The West wants cheap commodities because it consumes them. The East, especially industrial Asia, wants control and stability of inputs, and it increasingly has the leverage to keep those inputs at home or allocate them strategically. So ask the uncomfortable question. If you were running a nation that wants technological dominance, would you ship your high-purity silver out the door so someone else can build the next generation of hardware? Or would you keep more of it inside your own system, feeding your own solar industry, your own electronics manufacturing, your own defense supply chain, your own energy infrastructure? You already know the answer. And that answer doesn't care what the futures price prints at 3 a.m. on a thin book. We warned you that the paper versus physical gap would widen. The first widening looks like annoyance. It looks like higher premiums. It looks like longer lead times. It looks like small spreads between regions. The next widening looks like panic. It looks like rationing. It looks like force majeure. It looks like cash settlement available. It looks like 1,000 polite ways of saying, we can't deliver what we promised. And when that happens, mainstream finance will do what it always does. It will pretend the terms were always that way. It will act like you should have read the fine print. It will blame you for believing the marketing. That's how institutions survive the moral consequences of their own structures. They turn betrayal into a lesson. They turn your loss into education. They keep the game going by blaming the people who trusted the rules. But you're not helpless here, and this is where the story shifts from dread to agency. You can't fix the entire system. You can't force the West to stop living on leverage. You can't force central banks to tell the full truth. You can't force media to stop laundering narratives for advertisers and institutions. But you can refuse to be surprised. You can refuse to be the easiest prey. What does that mean in practice? It means you stop worshiping the spot price as if it's the voice of God. The spot price is a tool. It is a signal. Sometimes it's a lie. Sometimes it's a reflection of leveraged flows that have nothing to do with physical availability. And if you tie your emotions to that number, you become programmable. I'm not telling you to ignore reality. I'm telling you to learn which reality matters. Watch the physical signals. Watch premiums as a stress gauge, not as a guarantee. Watch lead times. Watch inventory reports. Watch policy changes. Watch the language governments use when they talk about strategic materials. Watch what industries do, not what influencers scream. The real world leaves footprints, even when the screen tries to wipe them away. And while you're watching those footprints, remember the oldest trick in finance. When the party is ending, the people inside the building will try to convince you the music is still playing. They'll dim the lights. They'll turn up the bass. They'll pour another drink. They'll call it resilience. But resilience doesn't require emergency measures every time stress appears. Resilience doesn't require midnight rule changes. Resilience doesn't require the constant management of perception. So when you see sudden violence in the tape during thin conditions, don't just ask, should I sell? Ask, why now? Ask, who needed this print? Ask, what story is being manufactured? Ask, what pressure is building underneath that needs to be relieved with theatrics? Those questions are how you stay awake. Because this is what the end of a monetary era looks like. It doesn't look like one collapse. It looks like a long sequence of credibility leaks. It looks like authorities insisting everything is contained, while quietly building new tools to contain it. It looks like a public trained to stare at numbers while the underlying regime changes. And then, one day, the regime is gone, and people act shocked as if there were no warnings. We warned you it wouldn't end quietly. We told you the party was over long before the lights came on. And here's the hard truth that most people can swallow. The reason this feels apocalyptic is not because the world is ending. It's because an illusion is ending. An illusion you were raised inside. An illusion that said the institutions were competent, the markets were honest, the money was stable, and the rules were the rules. What happens when that illusion dies? People don't just lose wealth. They lose orientation. They lose trust. They lose the mental map that told them how to plan a life. And that's why the system fights so hard to keep you asleep. Because awake, people start making different choices. Awake, people start asking for the real thing. Awake, people start refusing paper games. Awake, people start moving their risk out of promises and into assets that don't need anyone's permission. Now, let me be crystal clear. Because I don't do fairy tales, and I don't do guaranteed outcomes. Silver can remain volatile. Paper markets can stay irrational longer than you want. Institutions can kick cans down roads that look endless until the day they aren't. If the trend breaks, if policy loosens, if demand contracts, if alternatives emerge, the squeeze story changes shape. But the structure we're looking at tonight is not a casual trade setup. It's a regime stress test. And the stress test is revealing something that should change how you see every headline. The West still thinks it can set the price of reality. The East is increasingly acting like reality belongs to whoever controls flow. The banks still think the crowd can be herded with candles. The industrial world is quietly building stockpiles. The media still thinks it can narrate you back to sleep, and you, if you choose, can step out of the hypnosis and watch the machine for what it is. So here's the moment I want you to hold on to the next time the screen flashes red and your stomach drops. The red candle is not necessarily a verdict on value. Sometimes it's a signal that someone is desperate to manufacture a verdict. Sometimes it's the sound of a pressure valve. Sometimes it's the last frantic trick of a system that has run out of clean options. Ask yourself, if this is just normal selling, why does it need to be so sudden? If this is just a healthy correction, why does it arrive during thin conditions? If this is just profit-taking, why does it behave like a raid? If there is so much silver, why do buyers still struggle to get the real thing at the implied price? If the rally is dead, why do the people who actually need silver behave like they're racing a clock? And then ask the question that matters most, the question that separates the sleepwalkers from the people who survive: regime change. What do you want to own in a world where the institutions will always save themselves first? What do you want to rely on in a world where contracts can be rewritten and rules can be temporarily changed? What do you want in your corner when the difference between paper and physical stops being academic and starts being survival? They will tell you to trust them. They will tell you the system is resilient. They will tell you that you're paranoid for noticing cracks. They will mock the idea that hard assets matter right up until the day they quietly accumulate them for themselves. They will call it conspiracy to talk about conflicts of interest, even as those conflicts shape policy and price. They will do all of that because their job is to keep you calm while they reposition. But you don't have to play your role in their script. You don't have to panic on cue. You don't have to sell because a candle told you to feel shame. You can learn to see the structure, and when you see it, you start making decisions from clarity instead of fear. This is the part of the story where the crowd usually asks for a simple instruction, a single trade, a neat little conclusion. And I'm not going to insult you with that. The people who survive transitions aren't the people who get a perfect entry. They're the people who stop letting institutions rent space in their mind. They're the people who understand that regimes die slowly and then suddenly. They are the people who position their lives so that the suddenly doesn't erase them. So the next time you see them smash the paper price, remember the anaconda. Remember the tightening that doesn't look dramatic until the breath is gone. Remember that export controls Don-ET have to be labeled a ban to behave like a choke point. Remember that industrial demand doesn't care about your chart. Remember that the East doesn't play the same game the West plays because the East is building and the West is trading claims. And remember the oldest lesson in markets, the lesson nobody wants to learn because it demands patience and emotional discipline. When a system is fragile, it becomes loud. When a system is cornered, it becomes theatrical. When a system is lying, it over-explains. The truth shows up first as stress in the plumbing, as policy tightening, as inventories shrinking, as delivery frictions, as spreads that whisper, "I don't trust your promises anymore." We told you this was coming. We told you the end of the illusion would feel like a series of strange, uncomfortable moments that don't fit the official story. And if you're feeling that discomfort tonight, good. That means you're awake. That means you're noticing the gap between the narrative and the mechanism. Because the real trap isn't the bear trap on the chart. The real trap is psychological. The real trap is getting you to believe that the paper price is reality, that the institutions are honest, that the regime you grew up in is permanent. That trap is snapping shut on millions of people who still think tomorrow will look like yesterday. But you're here. You're listening. You're paying attention. And that changes what happens to you when the next phase arrives, when the tightening turns into visible strain, when the temporary measures stack up, when the market's polite language can no longer hide the fact that the era is ending. The party is over. The mask is slipping. And the number on the screen is starting to confess.